Good afternoon and welcome to the Loungers PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Nick Collins, CEO. Good afternoon to you, sir.
Good afternoon, everyone. That sounds a little bit better. Apologies about that. Thank you very much for joining us for our interim results presentation for the 24 weeks ending the 1st of October. My name is Nick Collins. I'm the Chief Executive. I'll go through some highlights. I'll then hand over to Gregor, our CFO, who's going to talk through the financial performance. He'll then hand back to me to go through the strategic and operational side of the business. So in terms of highlights, we're delighted with another strong financial performance in the first half. We've seen our like-for-like sales grow by 7.7%, and importantly, they're up 25% on a 4-year basis. Adjusted EBITDA under IAS 17 basis of 17.3 million is materially up on the 13.5 million we saw at the same time last year. And our margin's improving. It's 11.6%, up 60 basis points, and we can see a clear path to pre-COVID conversion. The rollout continues very successfully. Our new sites continue to perform very strongly, and I'll talk through some examples in due course. And the property market remains very much in our favour. Rent as a proportion of sales is now reduced to 4.4%. And current trading remains strong. We're approaching Christmas with optimism. Last week and this week have been good, and we've seen no change in the way that our customers are behaving despite the economic backdrop. And finally, before I hand over to Gregor, as you may have seen, Gregor notified the board of his decision to step down as CFO at the end of July 2024. After 5 years with Loungers, he's decided he's had enough of the commute from Dorset to Bristol. Goes without saying that we're enormously grateful for his massive contribution over the last 5 very challenging years. But he's not off yet. He's here till the end of July, and will be joining us for the prelims roadshow at the year end. There's a recruitment process underway, and Gregor's very kindly allowed us plenty of time to ensure there's a smooth handover. So on that note, I'll hand over to you, Gregor.
Thank you, Nick. I'll follow a pretty well-trodden path, if I may, with some financial highlights and then a little deeper look at our like-for-like sales performance, our margin performance and inflationary pressures, a little look at cash flow, capex, year-end net debt position, and then finally just what the impact of us having a 53-week year will be on our final results in July. So in terms of highlights, I think the overwhelming highlight for me is the fact that I'm able to share some numbers with you which are not having to be adjusted for the impacts of COVID, be it lockdowns or government support measures. So it's quite a pleasure to have 2 columns of numbers which are clean. And clearly there are some really significant highlights within them as well. So revenue of just under 150 million, that's up 22.3% year on year. And what you see there is a combined benefit of an additional 32 sites added by the end of the first half FY24 versus first half FY23. But then those new sites underpinned by a really strong like-for-like performance in the mature estate, so up 7.7% on the year. And we'll talk a little bit about that like-for-like sales performance in a slide's time. And I think the other really big highlight on that first page is the adjusted EBITDA performance under IAS 17, so after a full rent charge, and very much the measure we look at internally. So EBITDA growth there up just over 28%, as Nick says, to 17.3 million, and what you're seeing there is the benefit of that 60 basis points improvement in the EBITDA margin, driven principally by cost of goods sold and better leverage over our site fixed cost base in terms of rent and rates. And those 2 positives offset by higher energy costs, which were well flagged. Finally, down that front page, PBT for the period of 3.9 million, that's up 39% year on year. In terms of our like-for-like sales performance, 7.7% for the first 24 weeks of the year. When we roll that forward another 8 weeks to the close of last Sunday, 7.6% for the first 32 weeks. So a continuation of that strong like-for-like performance. And as ever, I think when you're looking at like-for-like sales in a business like ours, it's really important to have some context. And I think the context here is the fact that in the 4 years pre-COVID, effectively going back to 2019, we've delivered like-for-like sales growth in the business of 25%. And that growth combines both price and volume. So we've got probably about 5% worth of volume growth relative to pre-COVID. And there aren't many in the sector that can say that. And I think when you look at the like-for-like sales that I've reported in each of the 4 half years since post-COVID, the really important message is that this isn't a business that at any stage has had to take a big step backwards. Even in those immediate weeks of reopening post-lockdown 1, when we took out all the one-off benefits of Eat Out to Help Out and what have you, the business still traded effectively flat, despite having to take out covers and so forth. So a really strong like-for-like message there. The next slide, what we do is we split down that 7.7% like-for-like sales performance and show how the different age cohorts within the estate have contributed to it. And once again, I think the really strong message is that when you look at those older cohorts, so sites opened effectively before April 2015, of which there were 55, you'll see that those 3 cohorts have contributed as strongly as any other cohort effectively to that like-for-like sales performance. So once again, I think that talks to the high standard of maintenance of those sites, the fact that they age exceptionally well, and then just the underlying level of evolution and development within the business, which is helping to drive sales in those older sites. Moving on to margins and inflation thoughts. So our underlying margin in the first half is up 60 basis points year on year. 60 basis points growth coming on the cost of goods sold line, and on the cost of sales line, sorry, and that cost of sales line includes both cost of goods sold and site labour. And effectively all of that 60 basis points growth is on the cost of goods sold line. So seeing benefit from moderating inflation, which is allowing us to hang on to more of the price we put on the menu. Also the benefits of new supply contracts entered into, but also operational efficiencies at site as well. So less wastage and a reduction in the differential between the theoretical gross margin the site should achieve and the actual gross margin it does achieve. The labour ratio year on year was flat, so effectively the business has absorbed the 9.7% national living wage increase that went through in April of 23, and that's a positive. Clearly, we have more challenge with the national living wage for next year, but I think the fact that we successfully absorbed this April's increase puts us in good stead for the future. In terms of site variable costs, they were negative 10 basis points year on year, and effectively all of that was sitting on the maintenance line, which rose from 1.7% of revenue last year to 1.8% this year. Energy costs were a negative 50 basis points year on year for us, and that was very much expected. The business entered into a hedge for its energy purchases back in May 20, which runs through to September of 24, and that covered the 165 sites in the estate at the time. Subsequent to that, we've put more sites into the estate. Their energy has also been brought forward through to September 24, but at materially higher prices. So we're seeing the impact of that in our energy costs. And in the first half of this year, energy represented 3.2% of revenue. Site fixed costs have given us 60 basis points improvement, and that's both in terms of rent, where the rent to revenue ratio has declined to 4.4% from 4.7% last year, but also in terms of business rates, which were down to 2.2% of revenue. Really a reflection of the new rates list, which was introduced on the 1st of April 23, and saw the rateable values of a number of our sites reduced. Central costs as a percentage of revenue were flat year on year, and that clearly remains, I think, an opportunity for the business as it continues to grow to see leverage of that fixed cost base. Final point, EBITDA margin up to 11.6% in the first half. It's worth remembering that margins in the second half of the year are typically much stronger in this business. So last year we did 11% margin in the first half, 12.9% margin in the second half. And that really reflects the benefit of Christmas trading, particularly in Cosy Club, but also the benefit of the fact that we'll take a little bit more price typically in the autumn-winter menus, which are launched in October, and that extra price is set against relatively little cost pressure in the second half of the business, with national living wage, for example, being set in April. In terms of inflation outlook, back in July when we met, we talked about those inflationary pressures moderating, and I think nothing has changed in our viewpoint. And when you look at our expectations for the full year in November relative to where we were in July, there is very little change. What we have done is taken slightly more price. So we'll have taken 7% over the course of this full financial year. We took about 4% in March, April, with the spring summer menus, and then another 3% in October with the autumn winter menus. In terms of food inflation, when we look at the 12 months, end of September 22 to end of September 23, we've got food inflation of just over 10%. That number was just over 13% when we reported back in July. But I think more importantly, when you look at how prices of our top 20 products have changed over the course of the first half, so looking at end of September 23 versus end of April 23, only 0.2% increase over that time. So that's real evidence of that moderating inflationary pressure. By the same token, the top 20 drinks products, they're up 2% over the first half of FY24, and we don't see any pressure in the second half on those lines. A little bit more in terms of energy pressure. So as I said, that May 20 hedge will come to an end at the 30th of September 24. We're currently buying our energy ahead from that period onwards. At the moment, we have about just under 50% of our electricity needs for the year ending September 25 purchased, and then a quarter of our electricity needs for the following year ending September 26 purchased. And all in, that's coming in at about paying just over 25p a kilowatt hour for that electricity at the moment, and that's about 14% higher than our current price in the business. And finally, in terms of the national living wage, had I been presenting a couple of weeks ago, I'd have been quite confident, I think, in telling you that I thought the rate would go to about £11.15 and a 7% or so increase. And I think we'd have seen that as a positive movement in terms of returning the national living wage increases to the 5 or 6% that we used to see pre-COVID. The announcement was higher than that at 9.8, going up to £11.44. And I think fundamentally what that means is that our views on price will change slightly, and in reality we'll need to take a little bit more price next year than perhaps we thought we would. But importantly, as I mentioned earlier, the 9.7% increase that went through in April 23 has been successfully absorbed by the business. A couple of slides on cash flow. The first looks at our cash generation over the first half of the year, and what we see is an increase in our cash generated from operations, climbing from 7.3 million last year to 14.9 million this year. So growth both in terms of our EBITDA driving that, but also better working capital performance. And in reality, that working capital performance in the first half was a little bit flattered. Typically, we would expect to see a greater working capital outflow in the first half, just due to the timing of the calendar. Over a full year, we continue to see a working capital inflow driven by like-for-like sales growth and the new sites added to the estate. And typically in any one year, you'd expect over the course of a full year, probably about a £5 million working capital inflow. I think more importantly and more interesting, maybe thinking on to the next slide, and looking at the cash flow performance over a full 12-month period. So this is looking at our cash flow performance over the 12 months to the end of the first half FY24. And in that time, and bearing in mind during that time, we've opened 34 new sites have been built out and opened. What you see is cash generated from operations of just under 44 million. Then when we take off that, effectively all our CapEx spend, which is not new site related, so both maintenance CapEx of a genuine nature, plus also project CapEx spend of 8.4 million, interest paid of 1.5 million, you come down to free cash flow of 33.7, and that is effectively 97% of the 34.8 million spent on new site CapEx. So what we see in FY24 is very much the business reaching that status of being effectively able to fully fund the new site rollout at that accelerated rate of 34 sites per year from cash generated from operations and working capital. Looking at what we spent CapEx on in the first half of the year, So a total spend on CapEx of 22.1 million. We then had our CapEx credits increasing by $1 million, so our net cash outflow that you see in the cash flow for the first half of 21.1 million. Now what was within that, we spent 18.1 million of net CapEx on new sites. So that was a gross spend of 20.1 million and then reduced by £2 million of landlord contributions. That spend of 18.1 million included 14.5 million on 16 new sites that were built and opened in the first half, That compares to opening 11 new sites in the first half of FY23, so that growth from 11 to 16 sites is what drives that increase in spend. The 16 new sites included 14 lounges and 2 bright sides, and the typical cost of a new lounge within that period is £800,000. The spend does include, within the first half, £1.1 million of Ormo Lounge, a very large lounge, very successful opening in Llandudno in North Wales, and Nick will talk to that later. The £2 million of landlord contributions is pretty much in line with the previous year. We'd expect to receive about £4 million in respect of landlord contributions for the full year. Maintenance capex of a true maintenance nature in the first half of £2.3 million. That represents 1.5% of revenue, so a little bit higher than last year, where we were at 1.3. And allied to that maintenance capex spend, which is sitting in the balance sheet, we have a P&L maintenance spend of 1.8% of revenue. So again, 10 basis points up on the previous year. Other elements of capital spend in the first half are a continuation of splash and dash investment of 0.6 million, the final spend in respect to the kitchen reset programme of 0.6 million. That programme ended in May, and then 0.2 million on the central spend, and 0.3 million in respect of advanced purchases, bulk purchases of lighting and roof flooring in particular, which will roll into new site opening capex in due course. Final couple from myself in terms of non-property net debt. Net debt at the end of the first half of 14.3 million. That's a 4.8 million pound increase on 9.5 million at the end of the first half last year. That 4.8 million pound increase in net debt needs to be seen in the context of a total capital spend of 43.2 million over the last 12 months, plus 2.7 million to fund the route acquisition, and 0.7 million to fund modest purchase of our own shares and the cash settlement of share awards. During the first half, we refinanced our bank facilities. The term loan was reduced from 32.5 million to 20 million with a 12.5 million pound repayment. At the same time, we added £12.5 million to our RCF, so effectively no change in total liquidity. There was no change in our covenants, under which we have significant headroom, and that facility was extended through to June 2026. So very much leaving at the end of the first half with a continuing strong balance sheet and funding position. And then finally, I guess having the ability to have a nice clean set of numbers this year, I've slightly complicated it by the need to have a 53-week year. We operate typically with 52 weeks, so we need every 5 or 6 years to have a 53-week year. And what that will do will add approximately £6.8 million to revenue, just over £1 million to our IFRS 16 EBITDA, and about £800,000 to our IAS 17 EBITDA. So you'll see a one-off uplift in results this year to reflect that 53rd week. And with that, I'll hand back to Nick, if I may.
Thank you very much, Gregor. So before I get into a little bit more detail, I just thought worth highlighting how we continue to deliver on the strategy that we set out at the time of the IPO over 4 years ago, despite all the challenges that we've had to face. It's a consistent sector-leading like-for-like sales growth, as Greg's already talked through, and improving margins as we benefit from scale purchasing and operational gearing, and we firmly believe there's more to come there. We're very comfortable operationally delivering 35 site openings per annum, and I think that these overall results demonstrate that. And that 34 site rollout is financed through internally generated cash flow. Net debt very conservative at less than 0.5 times EBITDA. As we talked about when we did our prelims, there's the proven potential scale of in excess of 600 lounges and 65 cosy clubs, and we have real confidence in those numbers, and that's driven by the strength of our new site openings. And we believe we have a best-in-class management team, and that management team continues to evolve as the business grows. And just thinking about sales and the consumer, probably the question we get asked the most, we haven't seen any shift in the way that our customers are behaving across the brands. That's consistently been the case for the last 18 months. No evidence that they're changing their behaviour as a result of reduced discretionary spending. However, historically, our growth has been volume driven. Typically, we'd be 3-4% volume growth, 1 or 2% price, and volumes are currently flat, with price dominating our like-for-like sales growth of around 6-7%. I think what's really important here is that our volumes are, however, materially ahead of where they were pre-COVID. And we think we're pretty unique in that regard versus the competitor set. As such, we're optimistic with regard to the outlook, and we expect to see a return to volume growth in the short to medium term. And why is that? Well, it's because we represent excellent value for money across all our brands. We've, without doubt, taken a lot less price than most other operators. And secondly, our constantly evolving all-day offer in all brands is so relevant and has never been better. And finally, our new site openings are performing very well. Now, the plan here was to show you a video of Lounge. We've taken that out, but you can actually see it on our website, on our lounges.co.uk PLC website. But what I want to do is just spend a few minutes going back on what the basics are of a lounge and what's driving this outperformance. Chart on the screen now looks at our sales mix. And what delivers this sales mix? It's our all-day offer. They have a lounge competes with coffee shops, it competes with sandwich shops, bakeries, restaurants and pubs, and that's really important. And looking at the pie charts on the screen here on the left, you can see our overall mix, 59% food, 41% drinks. Then looking at the pie charts in the middle and the breakdown of our food sales by category, and you see brunch at 28% of our food sales, a really important category for us. Burgers 19%, and in our other mains, you can see how some of those sales are shifting towards vegan food, more Asian food, and sandwiches at 10%, a very important category, as is tapas at 11%. And that tapas really helps to drive our evening sales. And then looking at the drinks mix on the right-hand side, hot drinks 25%, so predominantly coffee there. Coffee is over 10% of our overall sales. And again, it's a really important driver of customer loyalty and return visits. Soft drinks 20%, and alcoholic drinks represent 22% of our overall sales. The bar chart in the bottom left there shows how our sales vary across the day of the week. And this is really important. 45% of our sales are generated between Monday and Thursday. There's a real balance to the way that our sales fluctuate across the week. Typically, with leisure operators, you'd expect to see a much stronger bias towards the weekend. And then the line chart in the bottom right shows how across the day our sales fluctuate. And again, we're generating meaningful levels of revenue right from 9 o'clock in the morning through to 11 or 12 o'clock at night. And it remains the case that this all-day offer is constantly evolving. From a food perspective, we're not wedded to any specific cuisine, which means we can sell what we want. And our 6 monthly menu changes keep us relevant and ensure that we provide our customers with choice. Introduction of lamb flatbreads and a lamb curry has been a great example of food evolution in the last 6 months, whilst we've ensured we're protecting our teams from a complexity point of view and indeed enhancing our gross margin. And we've introduced some new cauliflower dishes, which have really helped strengthen our vegan offer. We've also enhanced our cold drinks range with investment in a new blended drinks offer. We've introduced new blenders across all the sites. We've vastly improved our milkshake offer and really upscaled our iced coffee section. And that's delivered a 50% like-for-like sales growth in iced coffee sales. I mention that because I think it really helps people understand the lounge model. Iced coffees are a relatively small part of what we do. But the mantra within the business is that there's always something that we can materially improve. There's always something that we can do better. And what we talk about in the business is, well, what's the next iced coffee? What's the next part of our food or drink sales mix which we can materially improve? In the top right there, you can see a couple of images of coffee, and there's a real focus in the business. And they take this into 2024 in terms of improving what is an already very good coffee offer. And we're trialing new crockery and a new blend of coffee. And in the lounge business, Christmas bookings are now available for tables of 6+, and there's no need for a deposit. I think we've got a degree more confidence now in how we drive Christmas bookings in the lounge business. Lounge isn't overly, like the lounge business is very balanced from a seasonality perspective, and Christmas isn't a vastly important part of its sales. But what we are learning is that there's probably a little bit more for us to take from a Christmas bookings point of view. We talk a lot about value for money, and as I mentioned at the start, how we believe it's a real significant driver of our sort of strong performance, and how as we look ahead to 2024, we think that's going to continue to be the case. And this slide here, which looks quite busy, but it's updating on the slide that we showed a year ago. And what it does is it looks at our pricing in Prospero Lounge, which is the lounge we opened in November last year in Stratford-on-Avon. That orange box in the middle takes a few core products that we sell and looks at how our pricing in the white column, that was where our pricing a year ago, our pricing today in the blue column, and then you can see the percentage increase in our pricing on the right-hand side. And then what we've done in the boxes around is look at the prices of our main competitors in Stratford-on-Avon. And again, seeing how they've shifted across the last year. And the triangles represent whether the red triangle suggests that the same product is more expensive than our price, whereas a green arrow is suggesting that those competitors are cheaper than us. Now, Stratford-on-Avon it's only one location. It's a snapshot, but it's interesting, and it's worth bearing in mind as well. This was all kind of collected verbally by our team, so it might not be kind of completely accurate. But as I said, I think it gives us a snapshot. What were my main takeaways when I look at this? I think firstly, just looking at this chart and looking at the other competitors, virtually everyone else is seeing double-digit like-for-like sales price increases over the last 12 months, whereas we've seen 6-7%. And I think that's on the back of 2022, where the prices our competitors took, where the uplift was more pronounced again. So I think it really helps understand why we believe we're becoming more competitive. Second point, just looking at the main coffee operators, Costa, Starbucks, etc. They're 20-25 pence more expensive than our coffee. And I firmly believe that our coffee is a far superior product, which you can drink in a much nicer environment, and you'll be served by much friendlier, more hospitable team members. Burgers, I think, are fascinating. Our entry-level burger with fries is £11.75. Looking across these competitors in Stratford-on-Avon, burgers are 14, 15, 16, 17 pounds. And I think it really helps demonstrate how we represent great value for money. And if you think about the national living wage increase, which Gregor referenced earlier, I think that's undoubtedly going to cause competitors to increase their prices more. And I think that will give us another opportunity to really highlight our value for money credentials. So the next slide, I think, just helps us really summarize the model and why we achieve such strong returns on capital. And whilst the last few slides have referred to Lounge, I think that this applies to Cozy Club just as much as it does to Lounge. Starting on the left, if you take our amazing hospitality and atmosphere, add to that the varied, freshly cooked menu delivered really consistency and that value for money that's so important. And that means that we have really broad appeal, and we have people coming to us on multiple occasions, all sorts of times throughout the day, throughout the week. And that then means that we're generating meaningful levels of revenue across both the day and the evening. If you put that alongside our low rent, so 4.4% rent to revenue ratio, the lowest in the sector by some distance, and add into that our low capex, so the fact that we're building these sites ourselves with our own internal build teams, that's what allows us to deliver consistent 30% plus returns on capital, as we have done for the last decade. Moving on to talk about Cozy Club. And we're forming the view, and I think we've had this view for a while, that there's a real opportunity for us to build on the existing level of sales in Cozy Club. We've seen a new managing director join, Lucy Knowles joined, and she brings both significant operational expertise alongside sales and marketing experience. Previously group marketing director at SSP, and prior to that, Lucy was MD of Corney and Barrow. We've also seen, much like in Lounge, seen the new autumn-winter menu launch, and that's seen the menu further strengthened. And I know Lucy's really keen to influence our first menu change, which will be our spring-summer menu at the start of the new year. Looking at the top right, we've launched Cosy Club Oxford in October, which was our 36th Cosy Club. It's a fantastic fit out, over 8,500 square feet on the first floor. And last week we achieved sales there of 85,000, which put it in the top 5 within the estate. And what we anticipate there, and this is what we see in other Cosy Clubs, is that we'll see steady sales growth as the daytime day part in particular matures. And that takes a little bit longer in Cosy Club than it does in Lounge. Christmas bookings are ahead versus last year, and unlike Lounge, the 4 weeks of Christmas in Cosy Club represented a material amount of sales. It's 12% of the sales. And Cosy Club returns on capital, as I've mentioned, in line with Lounge, but we think there's more in the tank. We think that there's more that we can do to drive sales and really maximise the way that we fill our tables in the restaurants. Then moving on to talk about Brightside, our new roadside dining concept. And the journey so far, we've opened in the first half of this year our second and third sites in Saltash and Honiton. They launched in June and August, and that was a really hectic period to open those sites amid school holidays when they're very busiest. We've seen average weekly sales of £22,500, and we're really happy with that. We think it represents a really solid start for Brightside. We've seen strong representation from people living locally, and we're happy with that because the community market's one that we know really well from our Lounge business. And we've also seen that the seasonality is very pronounced. School holidays exceptionally busy. Looking at the sales mix in Brightside, 75% food, 25% drinks, which is quite different to Lounge and Cosy Club, where we see a stronger, a more even mix between drinks and food. But interestingly, the best-selling dishes are the breakfast and the burger, which is really consistent with the best-selling dishes in Lounge and Cosy Club. Customer feedback's been excellent. I think we're really confident we're delivering a great product and experience. And the negativity, we experienced some negativity right at the start when we launched Brightside, but those legacy, more value-driven customers have now largely moved on. We do have a need to grow sales, and we need to do that through building awareness and familiarity. I think what's important is that Brightside is very different from a Lounge and a Cosy Club. When we open a Lounge or a Cosy Club, they're immediately a captive audience who are walking past on a daily basis, whereas with Brightside, we need to get people to stop the car. The marketing strategy continues to evolve, and we're learning what works and what doesn't work. I think what's important is the journey's just starting. It's too early, far too early to talk about scale, long-term ambition. But what I can say is that we're really excited about it and its potential. And I think as these results demonstrate, us opening Brightside certainly hasn't distracted from the Lounge and Cosy Club rollouts. Moving on to talk about property and some property headlines. As Gregor mentioned, we've opened 16 sites this year, and in the first half, and we've opened a further 7, so we're now up to 23 new site openings this financial year, and we're on track to deliver the 34. We've talked about rent and how that's reduced to 4.4% of sales, and that's the lowest in the sector. If I look at the spread of those new site openings, there's a slight bias towards the northeast and the southeast, and those areas where we're less represented. But there's still plenty of infill opportunity right across the UK. And there's no doubt the property market continues to be very tenant friendly. We continue to source prime pitch opportunities, predominantly former retail or bank units, and landlord packages remain very competitive. Albeit we do anticipate with interest rates rising that we'll see that split between capital and rent-free period moving a little bit further towards rent-free as in the future. And we're using more footfall and demographic data to draw conclusions about the existing estate, new opportunities, and the overall potential scale of brands. As we have done in the past, taking you a few case studies just to understand the types of sites and locations that we're opening. This first one looks at Navio Lounge in Nantwich, which is a really beautiful former Barclays Bank. We opened here in July of this year, And looking at the kind of the property metrics, very typical for a lounge. 15-year lease, rent of 60,000, just below our average, and a landlord package of 24 months in this case, which was all in capital. Gross average weekly sales of 37,000, put it in probably the second quartile, and net capex of 840,000. Great forecast return of 36%. And looking at the map on the right, showing the Nantwich town centre, really typical in terms of competitor set, particularly from an F&B point of view. Mainline coffee brands including Costa, Cafe Nero's. And what's quite interesting here is that there's no JD Wetherspoons. One of the reference points we talk about in terms of potential scale of the business when we say there's capacity for at least 600 lounges across the UK. JD Wetherspoons is an interesting reference point. There are over 800 JD Wetherspoons across the UK, and there are a number of towns where we trade where there isn't one. So I think that helps. Next case study looks at Ormo Lounge in Llandudno. Well, we wish all our lounges were performed as well as this one. We always had a high level of confidence in terms of how we trade in Llandudno. We trade really well in Wales, and we know that we trade really well in coastal locations. We opened here in May 2023. It's in a former M&Co clothing shop. It's a really, really beautiful property. And looking down, capex 1.3 million. That's a big number for a lounge, well above the average, but absolutely worth it. As I said, we had real confidence in how we perform here, and I think that's the way that the business has evolved over the last few years. Is that we've got more confidence in terms of the levels of sales that we're going to generate in locations, and that allows us to spend a little bit more on capex, or it might allow us to spend a little bit more in terms of rent. Rent here is very competitive as it stands at £64,000, but gross average weekly sales over the first 27 weeks of £63,000, which is right up there in the top 5 lounges. It was a record opening in the summer. It is seasonal, but not as seasonal as you might expect. And nearest sites in Bangor, Clio Lounge 21 miles away, in Prestatyn, Torello Lounge, and there's more opportunity for us in North Wales. One of the things that's great about the lounge model is the versatility of it and how we trade really strongly in a variety of different types of locations. Our bread and butter historically has been secondary suburban high streets or market towns, but as these slides show, it is very versatile. Looking at them in turn, in the top left, Armado Lounge in Plymouth is on the Barbican, and we have Secco Lounge, which is probably 3 or 4 miles away, and a Cosy Club, which is just 1 mile away from here. And this was in a former Edinburgh woolen mill and has achieved a great average weekly level of sales of 41,000, albeit that's likely to come down a little bit as we go through the winter. And we opened there in May of this year. In the bottom left, we have Caballero Lounge in Leeds, which is in the Springs shopping centre, just to the east of Leeds. We opened in there in February of this year. And we're seeing real success in some of these mixed-use retail leisure parks. They form a minority of the kind of type of sites within our estate, but they do perform really, really well. Where we have confidence that these schemes have great footfall throughout the day and the evening, then we really enjoy putting lounges in them. And we've got similar lounges in Rushton Lakes, in the Midlands, in Foss Park, and in Leicester. Gloucester Quays is another good example. In the top right there, you can see Martino Lounge in Morpeth, which we opened in August. That's in a former Laura Ashley. And we've also opened sites in Hexham more recently, and indeed on Wednesday of this week, opened in Cramlington. So all 3 suburbs of Newcastle, and we think there's probably 6 or 7 sites and opportunity for us in the suburbs of Newcastle. Then bottom right, Accordo Lounge in Deal. It's a great example of a coastal town lounge, and as I've already mentioned, we trade really well by the coast. Opened here in August and delighted with the way that the site's performing. Next slide we thought we'd pull together just because I think it's interesting to see what we're replacing on the high street. We're a big business now, approaching 250 sites. So, what are we replacing and where have our sites come from? And this slide shows out of the 60 sites that we've opened over the course of calendar years 2022 and 23, what are we replacing? And typically our bread and butter is columns 1, which is former retail units, column 3, which is former banks, and then the 4th column, which is where developers are creating new space for us, typically where they're putting something down and putting a new development up in its place. And you can see just there from the names on the left, the changing nature of the community high street and some of the really well-known names that we're replacing, and in particular clothing retailers and the likes of Arcadia, Topshop, Burton's, etc., and M&Co. Interestingly, in that second column, how there are more former restaurants. And I think that's a function of how many have closed over the last few years. We've always been really cautious about opening in former restaurant premises, largely because of the legacy impact, and that legacy can have a negative effect on people's perception of those sites. And thinking about new developments, and the Loungers PLC covenant is really attractive to new developers, and it continues to get more and more attractive as the business grows and as our debt reduces. Next slide talks about the good stuff, which is our internal name for ESG. And historically, we haven't really shouted about it, but there's an awful lot that we've done really, really well. And I think over the course of the last kind of 6-12 months, we've recognised the importance of it, and particularly with regard to how it impacts our teams and how it impacts the communities in which we serve. And so we have a committee now which meets monthly to drive the agenda, and what this slide represents is our ambition from an ESG perspective. I don't propose to go through it all in detail, but I think picking off some of my personal highlights from it, looking at the left-hand side and thinking about community. Community is such a central part of our business, and that ambition to host 10,000 community events is something that we do so well. And when we think about community, when we think about charity, we don't think about it from a national point of view or from a company point of view. We think about how it touches the individual lounges within those communities. And then again, looking at community, and that ambition to provide 10,000 free meals for people in need. I think we have a real opportunity to help address food poverty in the locations where we trade. Thinking about our teams and that ambition to have 50% of management roles to be filled by our internal hires by 2028. Internal progression is really, really important to us as a senior team. And given our growth and our scale, we have a real opportunity. If people want careers in hospitality, then there can't be a better provider in the UK, and so we want to be really ambitious there. And then thinking about the planet and that ambition to increase our recycling by 10% and food composting by 20% by the end of 2024. I think there's definitely an awareness that we can do better, and it's something that our teams want us to do better. And then thinking about our teams, we continue to invest in our people, and this next slide just talks through some of the headlines. And the recruitment landscape definitely continues to gradually be more employer-friendly. One of the key trends that we're seeing is that trend of a younger team wanting fewer hours across the week. That's obviously having a marked impact on our workforce. We've reworked our bonus structures during the first half of the year at site level to make sure there's real alignment in terms of incentivisation. And a real focus for us going into 2024 is on team development and progression. We want to be famous for building careers in hospitality. And the second half, we'll see our emphasis on and investment in learning and development really ratchet up. Lounge Fest, which is the kind of the real pinnacle of our people calendar. Lounge Fest 2023 is a great success. Our investment of 0.7 million, I think it's really worthwhile. But we will start to get our supply base to start funding that from 2024. So just to conclude, I'm not Alex, the Executive Chairman, but just by way of conclusion, the consistency of the sales performance highlights the relevance of our brands and the opportunity in front of us. There really is so much for us to go for if, and this is really important, we continue to evolve and protect and nurture the culture. But I think we've really demonstrated over the last 10 years that we are very good at that. And that 650 plus site target for Lounge and Cosy Club really feels conservative as we continue to open sites in new locations, and those locations perform really well for us. We do believe we've got a significant role to play in the transformation of the high street. I think we're really proud of what we do from a community perspective, through job creation, through investment, and just providing great places where locals can spend time. And finally, we do believe we've got the strongest senior team in the sector and have an opportunity to have a real influence on eating and drinking out in the UK for years to come. So on that note, I'm going to stop, and I think we're going to answer some of the questions.
Yep, perfect, Nick, Gregor, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation. And Greg, if I could just hand over to you just to share the Q&A, I'll pick up from you at the end.
Lovely. I'll read the questions, and Nick and I'll answer them. The first one is from Ian S, and he's asking, what are the company's expectations and preparations for the upcoming Christmas trading period, and how does this fit into the broader outlook for the financial year?
Shall I begin?
Absolutely.
More of the same, really. I mean, we touched briefly on saying that we're optimistic in terms of Christmas. I think there's a buoyancy in the sector about Christmas. We have the benefit of 4 bookings in Cosy Club and to a degree in Lounge. I think the way Christmas falls this year is helpful, it being at the start of the week. And yeah, so as I said, more of the same. And I think it's easy to look at like-for-like sales over shorter periods, and yeah, they can fluctuate as a result of weather, school, bank holiday timings, etc., etc. But you know, as I mentioned right at the start, we anticipate a return to volume growth. We'll take some more price, and we think, you know, from a competitive perspective, we're really well positioned.
I think a really important point on Christmas in the Lounge business is the 4 weeks of December account for 8% of Lounge's annual sales. So it's not a massive period. It doesn't have the peaks that you'd expect most hospitality companies to have. Cosy Club is a little bit more Christmas focused with party bookings, where the 4 weeks represent about 13% of its annual sales. Next question from Samuel Lee, asking what steps are you taking to attract new customers and to retain existing?
I think the same steps that we've taken for the last decade really, in terms of it, particularly within the Lounge business. In Lounge, we're not a very sales and marketing led business. We're a community business, and that's how we think about it. So from a product perspective, it's constantly evolving. There's a restlessness within the business to make sure that we are delivering as well as we can from a food and drink development point of view. Constantly challenging, as I said with the example of the iced coffees, but exactly the same with the food, and just gently pushing our customers, I think, a little. I mentioned the breakfast and the burger. The breakfast and burger will always be our best-selling dishes. I suspect they'll be our best-selling dishes, but that doesn't mean that they can't get better. And then on the dishes which might sell lower volume on the menu, again, just looking at what's happening in London, elsewhere in Europe and the world. Again, and evolving the menu, introducing new flavors, etc. Yeah, that's how we've kind of maintained the really consistent level of like-for-like sales growth that we have historically. I think just on the Cosy Club side, and I mentioned how we think there's more in the tank, and that Cosy Club is more sales and marketing driven. So Cosy Club is a brand. We market it more as a brand. And I think, as I said, with Lucy's introduction into the business as Cosy MD, we're excited about pushing more there.
The next question is from Richard S. It follows on from Samuel's pretty neatly. First of all, Richard thanks us for talking to him. Well, talking to you all, but it's a pleasure. And the question from Richard is, given that lounges don't really market centrally, what's the plan to drive volumes in 2024?
And referencing more off-peak offers and increase the focus on community events, how do you get more people through the door when prices have leapt quite a bit? It's a really good question. And I think Offers, no, and a really fundamental part of the lounge model. We don't do loyalty schemes, and we like the informality and we like the flexibility of saying to our team that if you want to give someone a free coffee or a free pint or a free slice of cake or a free burger, please go for it. They have that autonomy, and that's fundamental to how we trade. I think increase the focus on community events, absolutely. We're always looking to kind of enhance that community focus. And one of the things we've done this year is we've introduced kind of regional community champions, and they're not there to tell the sites what to do. They're there to kind of encourage best practice, to share best practice, to encourage someone within a site to take the lead and to make sure that they're reaching out, that they're thinking creatively, and that they understand that there aren't any rules. We're very happy for them to engage how they like with their community.
I think fundamentally, though, it's Nick's point from earlier, it's that just continued focus on evolving the offer and giving more and more opportunities for people who want to come and visit us every week. Next one from Marcus A. How is the increased capital expenditure aligned with the company's growth strategy, and what areas are being prioritised for investment? Well, I think fundamentally our capital expenditure plans each year are driven by that new site opening programme. And clearly our new sites are 75% plus of our total capital expenditure in any one year. Ancillary to new site capex, we have relatively modest amounts of investment in terms of splash and dash. It's not a business that has a fixed cycle for reinvestment in sites, so that's not a drain on capex. And then clearly we have an element of central capex spend to ensure that we're investing correctly in systems and process to support the growth, but also projects, for example, like the back of house reset program, which are all focused on operational efficiency and making life as easy as possible for those of our teams who are working at the sharp end.
So it's one, how are we managing the balance between implementing necessary price increases and maintaining customer loyalty in the face of inflation? And we've talked about this a little bit already, but I think what's really important is yes, we've increased our prices, and in the old days pre-COVID we were taking 1 or 2% a year. And we've recently taken 7%, and there's a big difference. But I think what's critical here, going back to that slide that highlighted the price differentials in Stratford-on-Avon, our view is that we represent great value for money, and we're constantly becoming better value for money, largely because we're in a very strong position from a margin point of view. We continue to grow, we have the benefit of scale, we have the benefit of operational gearing. And if you compare us to a more mature business that doesn't have that benefit, they're just to maintain margins, they're having to push so much price through. I think one of the big conversations we have within the business and with our PLC board is, are we taking enough price? As a team, we're very cautious, but going back to that burger in Stratford-on-Avon, our £11.75, there's probably a strong argument that that's too cheap, and that we could take a little bit more price. But I think I'm really happy that we're on the cautious side of that, and we'll constantly challenge kind of how much price we should be taking.
Got a couple of questions now from Richard S. The first one is price and volume, which I think we've probably covered. But the second one is asking us, what are the 1 or 2 new things you'll do in 2024 to get to 8 out of 10 people enjoying working at lounges?
That's a really good question. We've done a lot in 2023, and a lot of what we want to do in 2024 is embedding what we've done in 2023. And we're an average payer, so we're not the best. We're very good for younger team members. We are above average for younger team members. But working in hospitality, there's 2 ways of looking at it. One thing that we really want to get better at is learning and development and providing career paths. With our growth, we should be the best place for anyone in the UK who wants a career in hospitality. And so 2024, and the first half in particular, was the Guy, our Chief People Officer, ensuring that anyone, we've really a clear path for anyone who wants to progress, and that we're making it really easy for them to progress. And so that's probably, I guess the top thing. I think beyond that, we have something which we call the commitments, which set out kind of the values that we want to have as an employer, and making sure that we're consistent with them. And the biggest risk in a business like ours, we employ 8,500 people, is that somewhere within the chain of command, you have someone who isn't behaving consistently with those values. And those values are all about paying fairly, treating people's time off with appropriate consideration, and making sure that we're protecting people's mental health and their work-life balance. So I guess the second strand is making sure that 2024 we are really kind of being held to account in respect of those, and we have lots of employee surveys and other things to make sure that that's the case.
One from Tom W here on the public markets not seeming to fully reflect the value of the business through the share price. The recent takeover of Restaurant Group by Apollo at only a modest premium. What do you think needs to happen in order for the markets to better reflect the intrinsic value of the business? Are we looking at share buybacks, progressive dividend policy, achieving greater mass through more site openings, end of the cost of living crisis, etc.?
Well, I think we'd agree with Tom in that we're not appropriately valued, and you can imagine over the course of the last 12 months, we've had many conversations with our advisors, brokers, Nomad, etc., and within the PLC board as to whether we should be doing anything differently to enhance shareholder value. And it's fascinating because when we speak to our institutional shareholders, some will say one thing, some will say another, and share buybacks, dividend policy, and one that I hope we've done better, where we have reacted, is in terms of making ourselves available to retail shareholders, and trying to be kind of more out there from that perspective. I think at the end of the day, ultimately, our perspective is that we need to really focus on what we do well, which is delivering that strategy that we set out at the time of the IPO, opening managers and cozy clubs, and increasing the profitability of the business and demonstrating the strength of us as a management team. And hopefully we're achieving that.
Thank you. Another one from Richard S. here in terms of headline chatter that the average high street is already saturated as far as restaurants and bars are concerned. How does Lounges know that they're not late to and at the end of the rollout party?
I mean, what we do is so different to anyone else and anything else out there. I think that's really important. And over the last decade or more, we've seen countless casual dining rollouts and businesses which have gone from zero to hero and back down to zero again. The likes of Jamie's Italians is a really good example. We're not a casual dining business. I think this is so important. We're not a restaurant business. I'll go back to when I talked about the lounge model. We compete with coffee shops, we compete with bakeries, we compete with restaurants, we compete with pubs, sandwich shops, we compete with everything and everyone. And if you look at the typical high street where we open a lounge, there aren't any restaurant chains. As I said, you'll typically see a Costa, you'll see a Starbucks, you'll see a Greggs, you'll see a JD Wetherspoon pub, and that's pretty much it. You might see a pizza operator. Those are the locations where we trade, and we trade so well there. And we see continued and enhanced success in those types of locations.
A couple here from Peter S, who asks, what metrics will you need to see from Brightside to continue the rollout, and what level of weekly sales, for example?
I think our initial, probably the easiest way or the initial way that we think about it is the level of sales has to get to where a lounge is. So an average lounge level of sales is 30,000 a week gross. So I'd say that's number one goal. And I think we acknowledge that's going to take time. When we open a lounge, we land on a high street, and everyone in that community has seen us coming because they've watched us developing it, and they all come in, and that just happens, and it's great. Brightside's quite different, and so it's going to take us a little bit of time to get up to that lounge level of sales, but we have real confidence in it. And I think in terms of KPIs, I guess the two really important things, actually Well, the first two things we'll look at will be sales and customer feedback. Are our customers telling us they like what we're doing? I think secondly, over the course of the next 12 months, we'll look to understand the return on capital in more depth. How should these bright sides convert at an EBITDA level? What's a mature CapEx number? What's a kind of an ongoing CapEx number for a new bright side? And then if we look at that overall return on capital, well, how does that compare to the 30-35% that we've achieved in Lounge and Cozy Club? And should it be competing in the future with Lounge and Cozy Club for kind of funding for rollout? Should it be incremental? Should it be additional? Or potentially, is it not worth it? Or would we be better focused, better just focusing on Lounge and Cozy Club? I think we've been really clear. Brightside is an experiment, one that we're really excited about. And in 12 months' time, I think we'll form a view as to what next.
Second one from Peter S is asking about London. Putney High Street needs us.
I know Putney High Street very well. And again, we probably work quite well in Putney High Street. It's when we typically think of London, we think of Greater London. And Gregor and I were in our site in Ealing earlier in the week. We're at Ruislip, Epsom, Orpington, Egham, etc. It's interesting. The closer you get to zone 2 and zone 1, one of the things that I suspect we find is that will the return on capital be as strong as it will be in North Wales? That's not a revenue perspective. That's more from a rent point of view, and the property costs as competitive. But the second thing with some areas of London is, will the daytime trade be as strong? Because if everyone's working and if everyone's commuting and going in, then there's a risk that we don't do quite as well from a daytime sales perspective.
And the final question is from Steve White asking, sorry if I missed it, but have loungers considered a loyalty card scheme? And if so, what were your thoughts?
You might have heard me mention earlier, Steve, but we basically, from a loyalty point of view, we prefer the informality of what we call random acts of kindness. So allowing our teams to, if they recognise that Nick's comes in every day for a latte at 11 o'clock in the morning, it's every now and again just giving Nick his latte on the house and just saying, because I think we much prefer that more natural level of hospitality rather than 6 stamps on a card and you get your free coffee. That said, I'd say 2 kind of caveats to that. One is it's really important that we challenge if we can use technology better. And whilst we're probably naturally quite technology averse, and we believe that the best hospitality is the interaction between our team and our customers, I think it's important that we challenge that. I think the second thing that we really ought to consider, and we haven't, is whether for our shareholders, whether there's something that we can do for our shareholders to recognise their kind of faith in us by giving them some sort of discount in the trading business.
Perfect. Nick, Gregor, thanks for that. I think you actually managed to address every single question from investors. And of course, the company will review all those questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Nick, could I just ask you for a few closing comments?
Absolutely. Thank you very much. Well, thank you for joining us. And I'd just like to reiterate that, we really are continuing to deliver on the strategy that we set out at the IPO, delivering consistent sector-leading like-for-like sales growth, and we're delivering improving margins at a time when our competitors' margins are shrinking. And we're really comfortably delivering the rollout of 34 sites per annum, and got greater confidence than ever in the potential scale of the business to grow in excess of 600 sites in the coming years. Thank you.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Loungers PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.